The indicator that predicted silver's last 50% rally is flashing red again. Is the silver market on the verge of an unprecedented explosion? For years, whispers of a silver squeeze have echoed through financial forums, often dismissed as speculative fantasy. But what if the next seismic shift is already in motion, concealed not in sensational headlines but in the complex machinery of market data? The financial world may be looking at the wrong signals, focusing on historical patterns while overlooking a potent, developing storm in the options market that suggests the undervaluation of silver is reaching a critical breaking point, one that could redefine its price for the foreseeable future. The core problem and simultaneously the immense opportunity in the silver market is its inherent structural tension. For the better part of a decade, the market has operated in a state of persistent and growing structural deficit. Demand, fueled by an insatiable industrial appetite for everything from solar panels to electric vehicles, has consistently outstripped the combined output from mining and recycling. This imbalance is not a fleeting anomaly. It's a chronic condition, with 2025 marking the 8th consecutive year of a shortfall. Yet despite this fundamental reality, the silver price has remained stubbornly range-bound for long periods, suppressed by a colossal paper market that often dictates sentiment over physical reality. This disconnect between the physical and paper markets has created a landscape ripe for disruption. The market has endured several so-called squeezes in the past. The first, a retail-driven phenomenon in the early 2020s, targeted physical bulk. While it dramatically inflated premiums, it barely nudged the spot price, revealing the immense power of the derivatives market to absorb such shocks. A subsequent tightening, driven by tariffs and logistical snarls, exposed vulnerabilities in the London good delivery bar system, hinting at a deeper fragility. But these events were merely precursors, tremors before the main earthquake. Each failed attempt has paradoxically strengthened the case for an eventual, more violent repricing. The true catalyst for the impending shift is not a retail frenzy, but a subtle yet powerful signal emerging from the derivatives market itself. A profoundly bullish skew in the options for the SLV ETF, the largest silver-backed exchange-traded fund. Financial analysts are observing a deviation in put-call spreads that mirrors the exact conditions seen on June 4, 2025. That specific date preceded a powerful rally that propelled silver from the mid-$30s to over $54 an ounce. This isn't just a random fluctuation. It's an indicator of sophisticated market positioning, suggesting that informed capital is making substantial bets on a significant upward movement. The put-call ratio is a critical barometer of market sentiment. When call options, which are bets on a price increase, significantly outnumber put options, which bet on a decline, it signals extreme bullishness. What makes the current situation particularly potent is the context. This bullish skew is developing after a recent price correction and a corresponding decrease in options volatility premiums. This combination creates a perfect storm. The lower premiums make bullish bets cheaper, encouraging more participants, while the preceding price dip has shaken out weaker hands and tested support levels, which have held firm. Furthermore, the structure of the SLV ETF itself has evolved. It is now almost entirely in the hands of a single dominant player in the precious metals space, J.P. Morgan. This concentration of control adds another layer of intrigue. For years, J.P. Morgan has been a subject of intense speculation, accused of suppressing prices through massive short positions, while simultaneously accumulating one of the largest physical silver hoards in history. Their consolidation of the SLV ETF means this powerful entity is now positioned at the very epicenter of the paper and physical markets, capable of influencing or reacting to market moves with unparalleled scale. The tipping point for this new squeeze will likely be a technical breakout that forces the hand of the market's most vulnerable participants, the short sellers. For weeks, massive short positions have been deployed in an attempt to cap the price, with sellers dumping the equivalent of 3 years' worth of global mining supply onto the paper market in just a 2-week period. Astonishingly, this monumental effort failed to push the price down by even 20%, a clear sign of underlying strength and voracious buying pressure absorbing every dip. These short sellers are now in a precarious position. The technical chart shows silver successfully testing and holding the upper channel of a trend that began in May 2025. What was once resistance has now become critical support. If the price continues to hold and then breaks decisively upwards, propelled by the bullish options structure, it will trigger a cascade of forced buying. Short sellers will be forced to cover their positions to avoid catastrophic losses, creating a self-reinforcing cycle where their buying pushes prices even higher, triggering more margin calls and more forced buying. This is not a theoretical exercise. The rally from $34.51 to $54.50 earlier in the year demonstrated the blueprint. Critical technical levels once breached were not revisited. The price established a new higher floor. We are now witnessing a similar pattern, but with the market having consolidated at a much higher plateau, currently battling to stay above the crucial $45 to $49 range. The next leg up will not begin from the 30s, but from a launch pad near $50, making the potential ascent far more rapid and dramatic. The immediate impact of this tipping point will be a rapid and volatile price increase. The initial target would be to decisively overcome the previous peak of $54.50. However, the underlying dynamics suggest a move far beyond that. With short sellers trapped and a flood of new momentum-chasing capital entering the market from the sidelines, a push towards $60 an ounce is not just possible, but probable. Some bullish forecasts from major financial institutions even place long-term targets in the $60 to $65 range for 2026, indicating that a move to these levels would be seen as a validation of fundamentals, not just a speculative spike. The aftermath of such a move would fundamentally reshape the silver market. A successful squeeze of this nature would permanently alter the psychology of market participants. The long-held belief that the paper market can indefinitely suppress the price of physical silver would be shattered. This would lead to a significant repricing of risk for anyone daring to take on a large short position in the future, likely resulting in a structurally higher price floor for the metal. We would also witness a significant compression of the gold-to-silver ratio. Currently hovering at an elevated 82:1, this ratio is far above the historical average, which many analysts place between 41 and 61. While central bank buying has disproportionately lifted gold's price, a genuine revaluation of silver would see it outperform gold significantly. A return to a ratio of even 60:1, assuming a stable gold price, would imply a silver price far north of current levels, underscoring its deep undervaluation. The industrial consequence cannot be overstated. Silver is not a mere trinket. It is an indispensable component in high-growth, recession-resistant sectors. A sustained price above $60 or even $70 would force a reckoning in industries like solar energy and electric vehicles. While manufacturers have become more efficient in their silver use, a process known as thrifting, there is a limit to this optimization. A permanent price reset would necessitate a recalculation of costs across the entire green energy supply chain, potentially accelerating the search for substitutes, though viable alternatives for silver's unique conductive properties remain elusive. For investors, the landscape would be irrevocably changed. The narrative of silver as a perpetually undervalued asset would give way to its recognition as a critical strategic metal. Investment demand, which has been the wild card, would likely solidify as a primary driver. The inflows into silver-backed ETFs would swell, further tightening the physical market as these funds are required to vault the metal, removing it from industrial circulation and exacerbating the supply deficit. The key takeaway from this developing situation is that the silver market is transitioning from a state of controlled suppression to one of physical reality. For years, the immense leverage of the paper markets has allowed for a price that does not reflect the severe and worsening supply-demand imbalance. The bullish options activity is the market's way of signaling that this artifice is becoming unsustainable. The game of hot potato being played by short sellers is nearing its end, and those left holding the shorts when the music stops will fuel the next parabolic move. This is not a situation analogous to the Hunt brothers' attempt to corner the market in 1980. That was an effort by a few wealthy individuals to control supply through leveraged futures. Today's potential squeeze is fundamentally different. It is rooted in a genuine global physical deficit being amplified by sophisticated financial instruments. The demand is not artificial. It is driven by a technological revolution in green energy and electronics. The pressure is not coming from a single source, but from a convergence of industrial necessity, investor safe haven demand, and informed speculative positioning. The role of central banks also looms large, albeit indirectly. Their voracious appetite for gold has fundamentally altered the precious metals complex. By aggressively accumulating gold, they have implicitly endorsed hard assets as a necessary diversification from fiat currencies. While they do not buy silver in significant quantities, their actions have anchored gold at a high valuation, making silver's relative cheapness all the more glaring and stretching the gold-to-silver ratio to a historical extreme. This creates a powerful arbitrage-like opportunity for investors to rotate from an asset supported by official policy to one supported by industrial reality. Furthermore, the global economic environment remains a powerful tailwind. Persistent inflation, geopolitical instability, and concerns over sovereign debt levels continue to drive capital towards safe haven assets. While gold has traditionally been the primary beneficiary of these flows, silver's dual nature as both a monetary and industrial metal makes it uniquely positioned. It offers not only a hedge against currency debasement, but also a direct stake in the technologies that will power the future economy, providing a growth component that gold lacks. The technical indicators are flashing a clear warning. The sustained price action above key moving averages, combined with the successful defense of the breakout channel from May 2025, forms a powerful bullish structure. The market's resilience in the face of massive short-selling pressure demonstrates a deep and committed base of buyers. This is not a fragile rally built on fleeting sentiment. It is a structural bull market consolidating its gains and preparing for its next major advance. The options market is simply confirming what the fundamentals have been screaming for years. What would a price north of $60 an ounce mean for the global economy? It would signal a new era for commodities, where essential industrial metals are valued not just for their immediate use but as strategic assets. It could trigger a wave of investment into mining and exploration. Although bringing new silver mines online is a notoriously long and capital-intensive process, meaning any supply response would lag demand by years. In the interim, the deficit would likely worsen, creating a feedback loop of ever higher prices. This impending squeeze represents the market's forceful reconciliation of two competing narratives. The first is the paper market narrative, where silver is abundant and its price can be managed through derivatives. The second is the physical market narrative, where silver is a scarce and indispensable resource facing a chronic supply shortfall. The evidence strongly suggests that the physical narrative is about to overwhelm the paper one. The disconnect has become too great to sustain, and the options market is the fault line where the tremor is beginning. Investors must understand the distinction between the prior squeezes and the one that is now developing. The retail-driven squeeze was a blunt instrument that, while well-intentioned, lacked the financial firepower and structural understanding to succeed. The tariff-induced squeeze was a logistical problem, not a fundamental one. This third iteration is different. It is a data-driven, institutionally recognized phenomenon. The extreme bullish skew is a signal from the smart money that the conditions are now optimal for a major repricing event. The final lesson here is about the nature of markets themselves. Any market that becomes too distorted, where the price of a derivative asset becomes detached from the underlying physical reality, is inherently unstable. The silver market has been in this state of disequilibrium for an extended period. The coming squeeze is not an aberration, it is a necessary and inevitable correction. It is the market's mechanism for restoring balance and ensuring that the price of a critical global commodity reflects its true scarcity and utility. The path forward will be volatile. The forces seeking to maintain the status quo are powerful and well capitalized. They will not relinquish control of the price without a fight. We can expect further attempts at suppression through concentrated short selling. However, the underlying physical tightness and the growing institutional awareness of silver's undervaluation create a powerful countervailing force. Each failed attempt to push the price down only serves to trap more short sellers and strengthen the resolve of the bulls. Predicting the exact timing of such a move is impossible, but the ingredients are all present. The technical structure is bullish, the fundamental backdrop of a supply deficit is entrenched, and the options market is signaling extreme positive sentiment. The rally from June to October of 2025 was a dress rehearsal. The main performance is yet to come. When it arrives, it will likely be faster and more dramatic than most market participants are prepared for. The psychological barrier of $50, which held for decades, has been decisively broken. The market is now in a phase of price discovery. The previous all-time high is no longer the ceiling but the new foundation. The battle is no longer about reclaiming old highs, but about establishing new, sustainable levels that reflect the realities of the 21st century economy. The move towards and beyond $60 will be the confirmation that this new paradigm has arrived. The broader implications for asset allocation are profound. For years, investors have been conditioned to view stocks and bonds as the only essential components of a diversified portfolio. The coming revaluation of hard assets like silver will challenge this orthodoxy. It will highlight the importance of holding tangible assets with intrinsic value in a world of unprecedented debt and monetary experimentation. Silver's outperformance will serve as a powerful lesson in the enduring value of physical commodities. The final catalyst may come from an unexpected source. While the technical and fundamental case is clear, a geopolitical event, a major policy shift from a central bank, or even the entry of a few large, well-capitalized buyers could act as the final accelerant. The market is a coiled spring wound tight by years of suppression and structural deficits. It will not take much to release that stored energy. Looking ahead, the question is not if silver will experience a significant upward repricing, but when and how high it will go. The data suggests that the process is already underway. The skirmishes of the past are escalating into a full-blown battle for control of the silver price. This time, the fundamentals are squarely on the side of a higher valuation. The options market is placing its bets, and the signal is clear. A major move is on the horizon. In conclusion, the confluence of a multi-year structural supply deficit, resilient industrial demand, a favorable technical setup, and an extremely bullish sentiment reading from the options market creates a compelling case for an imminent and powerful upward move in the price of silver. This is not just another speculative flurry. It is the culmination of years of market tension and a fundamental disconnect between the paper and physical worlds. The aftermath will leave a permanently altered landscape. A new, higher price floor for silver will be established, reflecting its critical role in the modern economy. The gold-to-silver ratio will compress, signaling a return to historical norms of valuation. And investors will be reminded of the enduring power of physical assets in a world of financial abstraction. The squeeze is no longer a question of if, but a matter of observing the catalysts as they unfold. The pieces are in place, and the market is holding its breath.